Why should you be a boring investor? We'll talk about that on the program, plus some of the big retirement changes that are coming your way. Good morning and welcome into the program. This, of course, is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, the show Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest-running radio programs, coming to you on a host of networks throughout the Central Florida region. We are also one of the top 25 financial planning podcasts on the World Wide Web as well. So make sure you subscribe to us on your favorite platform. Before we go to those topics, though, a lot of economic and market-related data that came out this past week. Only appropriate that we, as we typically do, spend the first segment sort of talking about the headlines of late and thinking about the week ahead. Certainly this past couple of weeks, the big headline was on the GDP number, the economic growth for the first quarter of this year. Less than what it was in the fourth quarter, 2.6. It dropped down to 1.1%. So clearly some form of economic slowing happening out there, as you would expect, considering how much the Federal Reserve has been raising rates over the course of just the past 13 months. A lot of rate increases in a short period of time eventually will lead to some economic slowdown. That, after all, is what the Federal Reserve is doing when it raises rates. So that is certainly ongoing. When you think about inflation, because that's one of the reasons why they're raising rates, inflation also sort of trending down, which I guess is the positive trend, if you will. 4.98% is the current rate versus a little over 6% in the prior month and over 8.5% from a year ago. Long-term perspective on inflation, somewhere around 3.3%. We think that at the end of the day, all of this will probably settle out in that 3 to 4% range. So again, always good to have historical perspective when you're thinking about these numbers, right? And so if inflation over the past 75 years has been around 3.3, then if you settle in around 4, then that's not so extreme relative to the averages. Unfortunately, we've come to a period of incredibly low interest rates, incredibly low inflation that probably not replicable for the future. A lot of reasons for that. Look at our podcast library to see a variety of them, but chief among them that sort of springs to mind is the whole demographic issue. There's not a cheap labor pool coming online as it did throughout all of Asia, as it has happened over the course of the past 20 years. The other part that is happening, of course, is this time of year is one of the quarterly earnings season, right? And first quarter ends. Here we are a little bit after 3 or 4 weeks after the end of the quarter, and you have earnings season in sort of full swing. This past week, companies like McDonald's, Microsoft, Google, Amazon actually reported better earnings. So market was up for the week a little bit. Since the beginning of the year, what's interesting is that there's been, if you think about the overall markets as measured by the S&P 500, actually been a little bit of an uptrend since the beginning of the year, despite all of these headlines that would say that the recession is just around the corner. We're going to talk more about that later in the program, but we want to think a little bit about the coming week. And the coming week has, speaking of the Federal Reserve, another Federal Reserve meeting. Calendar is flipping to May, if you can believe it or not. I think that, that happens tomorrow. And so the year a third over, Federal Reserve meeting yet again this coming week. And ultimately, the expectation is that they're going to raise rates at least one more time, probably in the quarter point variation. That's sort of all assumed or priced into the markets these days. So the real issue will be what they give for guidance in the future. Hopefully it's we're going to just pause and see how all of this plays out, because they've done a lot of rate increases in a short period of time, and ultimately it takes time for those to all work themselves into the economic numbers. Of course, more earnings. A lot of companies are still continuing this earnings season reporting, and I guess I would suspect that during the course of this week, it appears that we're going to have another headline involving a bank. This time it is First Republic. It looks like the folks at the Fed and the FDIC are in the process of perhaps engaging in a little bit more structured approach in terms of First Republic versus what they did with Sovereign Bank or Silicon Valley Bank. This time it looks like there's sort of a weekend type of bidding process that ultimately will have First Republic merging into the likes of JP Morgan, those types of things. So don't be surprised if tomorrow you wake up to that headline where there's been another sort of, and I'm sure the media is going to describe it as a bank failure. The reality is that in a lot of ways it certainly met that metric, but this one, in contrast to some of the two early ones that happened earlier this year, probably going to be a little bit more structured, if you will, on that. So certainly there'll be some headlines on that. One of the things that we wanted to talk a little bit about, and we talked about this a couple of weeks ago, is just to give some more flavor. We were starting to develop on the program the theme of perhaps thinking more about international, more about global these days. And part of that is consistent with sort of what our investment approach is as a firm, which is that we like to have our clients investing in big, giant companies that make the stuff that the world uses every day. And certainly that doesn't make it immune from the ups and downs of the market, but you got to believe companies like McDonald's and Microsoft and Home Depot and things like that are still going to be around. And so one of the things that we were talking about is making sure that you had a good perspective in terms of the overall diversification of your portfolio. And sometimes diversification means more than just types of companies. Sometimes it means regions, and particularly when you hear sort of the numbers as to where these large companies are located and how much that has changed really over the course of the past 20 years, you really may want to dig a little bit deeper in terms of what your investment allocation is versus how much is based on companies that are headquartered in the U.S. versus companies that are headquartered outside the U.S. Here's the numbers. In 2003, there was about 2,000 sort of these large companies. And by that, we mean over $1 billion in net sales per year. So that's a pretty good size company. That's not your local, round the corner type of business. These are large global conglomerates. And so 20 years ago, there was about 2,000 of them. Roughly about half, 50%, were actually in the U.S., meaning they're headquartered in the U.S. Now, fast forward 20 years, and the reality is that the number of companies that would sort of qualify for that metric has about doubled. It's a little over 3,700. But here's the thing that has happened that gets to the core of this whole diversification and how much I need to have more on an international or global side. The percentage of those mega cap or those really large companies winds up being located here in the U.S. dropped from 50% from where it was 20 years ago all the way down to about 25%, 27% if you're going to be exact, in terms of companies that are headquartered here in the U.S. So certainly something to think about from an investing perspective is that diversification, particularly when you think about the world at large and where large companies are ultimately located. So with that thought, we're going to take a break and continue here on the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Talking a little bit before in the break about the notion of paying a little bit more attention to regional location in terms of your investment portfolio. The reality is that there's a lot of large companies all over the world now, about 100% increase in the number of companies that have over $1 billion in net sales just in the past 20 years. As you might well imagine, the U.S. was home to about 50% of those 20 years ago. Today, it's home to about 25% of those. So an important thing to be thinking about when it comes to your investment allocation. A lot of big global companies that are selling their stuff all over the world that don't necessarily have headquarters here in the U.S. So certainly something to be thinking about in terms of diversification. Speaking of that, once again, we have a narrow market developing that obviously pros if you own the narrowness of the market, but cons because it doesn't allow for diversification. And so one of the statistics that's happening is we're back to talking about sort of the FANGs-ish, because the FANGs might very well have just become Ma, I guess would be the new description of it. So if you recall, certainly this is something that we've talked about along the way over the years on the program, the companies that make up FANGs, if you will, and it was the first letter of sort of Facebook, right? Amazon, Apple, Netflix, Google, right? That made up the name FANGs. And at one point, that small group of companies was driving over a third of the performance of the overall market as measured by the S&P 500 over the course of the past 5 years, right? So if you owned those companies, great, you were participating well until last year when a couple of those letters in the FANGs went down by 70+%. That would be Facebook, that would be Netflix. So again, underscoring why sometimes if you just own the market, you may not be as diversified as you should be. Well, once again, there is that brewing yet again, because when you look at Microsoft and Apple, so we'll call this the Ma portion of the market, they've risen, those two companies have risen to be weighted over 13% of the total index weighting of the S&P 500. So a lot of times what you're seeing in the markets isn't a true reflection of what's going on out there as a whole. So let me break that down a little bit more for our listening audience. So the S&P 500, widely viewed as sort of the broadest market index, is a market-weighted index. That means the bigger you are, the more you control the increase of that index. So the more you sort of drive the performance of that overall index. Well, if you think of the S&P 500, well, that's 500 companies. The reality is that you have two companies, Microsoft and Apple, that are responsible for driving over 13% of the performance of that index. That is the highest level on record going back data over the course of the past 30 years. So good news, bad news on that is that if you don't own Microsoft and Apple, then you probably are underperforming. The bad news is that that's never good to be undiversified or overly concentrated in a particular company. But certainly that is what is happening so far, is that you've had a very narrow market driven by a small group of companies, particularly Microsoft and Amazon. Matter of fact, if you think about where the S&P 500 is so far this year, as we stand right now, it's up about 8% for the year so far. Only six companies, obviously technology companies, contribute about over half of that gain, 53% of that gain coming from just those 6 companies. So just sort of as we're thinking about diversification, as we're talking about international versus global, things like that, also be thinking about concentration, because sometimes owning an index doesn't have the kind of diversification that you might expect, particularly when if you own the S&P 500, the reality is that 13% or over 13% of that portfolio is concentrated in just 2 names these days, Microsoft and Apple. That's the highest amount of concentration that we've ever seen from just 2 names happening in that index. So certainly something to be thinking about, along with all kinds of things to be thinking about, which of course, hopefully that's why you listen to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Plenty to always talk about each and every week on the program, whether you catch us here live on air, the variety of stations that we're on throughout the Central Florida region, or whether you catch us at your leisure on your favorite podcast channel. We're always here to talk about today's headlines and to talk about how best to be positioned as an investor, and certainly some things to watch out for along the way. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries, and they all stand ready this week to help you improve your life with a successful and cost-effective financial plan. So, what's the overriding headline beyond what we've just sort of been talking about so far in the program? The overriding headline is the imminent recession that is coming, right? It doesn't matter where you look, whether it's the internet or mainstream media or whatever the case may be. That's all the headlines are. That's all the conversation. The recession is coming. The recession is coming. It's like this constant message that is getting drilled into everybody's head. And I think for a lot of investors, it probably has sort of paralyzed them into not really knowing what to do. Well, we want to give a little perspective on that, because what is not being said in that message is that if everybody is talking about it, then it's not new information, right? So if you think of markets and economic headlines, markets typically are anticipatory. They are leading indicators of what is going to happen down the road. Historically, we know that market declines typically will predate recessionary periods of time. They don't perfectly overlap, because usually the market starts to anticipate the data getting worse and then prices that in accordingly. Oftentimes, markets actually start their recovery in the middle of a recession, sort of like when the headlines are the darkest, right? It's always darkest before the dawn. Well, market kind of operates the same way as well. So just keep that in mind. As you hear this headline, the recession is coming, markets certainly follow the economy, but they're often leading indicators, not concurrent or lagging indicators in terms of what's going on. So, and this is particularly relevant with the statistic that we actually stumbled upon just the other day, which looks at the length of the current bear market. So let's talk about what bear markets are. It's a definitional term. It's a term that says we've had a market decline of more than 20% since its peak. 20%, why that was picked, have no idea, just an even round number. But the reality is there's been certainly plenty of 18% declines over the past couple of decades that certainly caught everybody's attention just as much. But in order to meet the technical definition of being a bear market, it has to be a 20% decline. So if you think about what happened last year, obviously, starting in January, the market slid at one point in September, the S&P 500, down about 25% during the course of that calendar year 2022. It has not obviously recovered and gone on to set a higher high, which of course is its history, right? Every time the market has gone down, there's never been a time where the markets have not recovered and set a higher high. Interesting little tidbit there if you think about it. The reality is, though, if you think about the length of time of sort of where things are in terms of this quote-unquote bear market that started in January, it's actually the longest stretch over the past 50 years in terms of the length of a bear market. The S&P 500 now, it's been going 221 days that it has been not set a new peak, if you will. Consequently, that puts it still in a bear market. And that, in fact, is the longest stretch since 1973, surpassing the lengths of sort of the sell-offs that happened in 2001 with the dot-com bubble or the financial crisis in 2008. So maybe that might help to put it into perspective. Markets have already sort of significantly and substantially priced in what would be an economic decline anyway, and are already sort of in that mix. So there may be a different conclusion to all of this in terms of what's going on. And we'll share that after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, talking a little bit about some of the interesting data as you kind of look at where the markets are based upon the length of time where they have been in decline. One of the statistics we were sharing with you in the last break is this notion of being in a bear market, which obviously the current market meets that technical definition, because that definition is the market down 20% from its peak. And certainly that happened during the course of last year, down at 1.25%, and has yet to go on to set a higher high. So that then by economic and definitional standards means that you're still in that bear market sort of segment. But what is interesting, I think, from a timing perspective, is that, of course, bear markets don't last forever. Markets got a pretty good track record, 100%, of going on to set higher highs after each time it declines. And so what's interesting in terms of the data is that right now, the current bear market is actually the longest, running now 221 days, the longest on record over the course of the past 50 years. And I guess the reason that we're sharing that is that perhaps that might put things into perspective, right? Because the reality is that if markets have already significantly and substantially priced in some type of an economic decline, then the only question remains is, have they sort of fully priced it in, and when will said economic event occur? Well, obviously we won't know that until the future, but it would seem to us that if that now is a great time to make sure that you are positioned properly. The notion of selling out and going away or just waiting it out on the sidelines doesn't really probably make sense, because most of the damage is done, right? So if that's the case, then maybe there's more opportunity in front than behind, particularly from an investing perspective. So not particularly a good time to just be kind of selling everything, going away, waiting it out, sitting on the sidelines. By the way, that's never a good strategy. We're going to talk a little bit more about that in this segment of why it makes sense to be a boring investor, and how that leads to investment success over time. So welcome on into the program. This, of course, is Dollars and Cents, one of Central Florida's longest running radio programs. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite platform of choice. When you get there, subscribe to us. That way you know when we upload new content on a regular basis. We do that about once a week or so. If you have any trouble finding our channel on your particular podcast platform, well, go to our website, Nelson Financial Planning, and you will see in the upper right-hand corner, or if you're looking at it on your phone, it's right there below the main line. You'll see a bunch of icons. Click on the one that looks most familiar to you, whether that is Spotify or Amazon or YouTube, whatever the case may be, and you'll get immediately connected over to our channel on that platform. My name, of course, Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So some of you may take offense to my next comment, but I think it bears repeating that, frankly, studies and headlines and reports continue to underscore that, sadly, the average investor is a bit of a knucklehead, okay? And the reason we say that is that if you think about the most popular strategies that are sort of current, right, over the course of the past couple of years, and how much they blow up, particularly when you get into more difficult times, right? Cryptocurrency would be kind of first on the list. Trying to time the market, buying the dips last year was not a good opportunity to try and do that. In fact, it was one of the worst years to try and engage in timing. If you thought that, oh, the market's down, I'm going to just kind of keep buying more, there was certainly some data that suggested it was not a particularly good year for that. Buying individual stocks, particularly, is always a tricky proposition, but I think more so than ever before, it's become an even harder proposition because of social media, what your friends are saying, what you're seeing posted, all of that. Winds up sort of chasing something that maybe sounds interesting, right? Like space tourism. Like, that's really kind of cool, but you have no idea whether that's going to be profitable or how far out is it going to take before anything like that becomes profitable. And that also sort of undermines the lack of diversification when you're just sort of owning or investing in one company. Margin options, those are just not even places that you as an investor want to head. Margin, right? I'm going to borrow against my portfolio to buy more. Leveraging is never a good idea, particularly when it comes to investing. And then options, oftentimes people don't have any idea how those work and wind up getting hit with big losses, particularly if you have any level of market volatility. So those are kind of the flavors, right? Think about crypto and timing and buying individual stocks that don't make any money, margin options. I mean, those are all kind of, I guess the only way to say it, knucklehead choices in a word. It just pays to be boring. And I understand that that's not anything that you can post on social media or you can talk to your friends at a bar about, but the reality is that that's really kind of the key to success, right? What are some of those investing fundamentals, all of which sound really boring, really tried and true and boring? Be diversified, right? What does that mean? Not owning just one company, not owning a concentration, not having all of your eggs in one basket, being consistent. Another boring. Who wants to be consistent? Day in, day out, same thing. Ugh, boring. Reality is it's time in as an investor, not timing, that gets you the best possible return over time. Of course, to be consistent as well requires you to maybe ignore the posts and ignore the media a little bit more than what you might otherwise be doing. And then lastly, to sort of continue the trend of why it's good to be a boring investor. Well, a boring investor would sort of own something that they know what it is, right? This company makes something. I use it every day. It seems to me like they're making a profit on it. So I'm just going to own that rather than, back to my space tourism analogy, right? I'm going to own a space tourism company because I think that might be really awesome. Well, the problem is that old McDonald's is selling a bunch of burgers on every street corner. So maybe that's something better. Boring. Yeah, I get it. But at the end of the day, oftentimes being a boring investor will allow you to not be a knucklehead one and chase after some of the many things that have become incredibly popular over the course of the past few years. That list is very, very long. And it sounds easy. It's boring. But the reality is that they hold that those types of concepts, being consistent, being diversified, owning what you know, holds the key to long-term investing success. It's not hard if you stop and think about it. It's kind of boring, but it gets harder and harder, more and more, and against our more needed now, easily distracted human behavior. With that, we'll take a break. We'll return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. And on this segment of the program, we thought we would talk a little bit about some of the ways in which folks are getting surprised about retirement. We've also got a lot of retirement changes coming your way, but I think we're going to hold that one for another program, maybe next week's program, simply because there's a lot of information that we need to spend going over on that. But one of the things that we talked about a couple weeks ago on the program was some of the sort of the surprises, if you will, about retirement. And one of those ones that we talked about previously was the notion that it could last much longer than you think, right? If you think the average life expectancy at 76 years sort of applies, it doesn't apply because actuarially, if you get to age 65, then you've avoided all the stuff that might take you in your 20s, 30s, 40s, and 50s. And so then you actually have a longer life expectancy because you achieved that age. So in fact, a 65-year-old woman has a 50% chance of making it to age 86. That's 10 years past the sort of the average life expectancy for the population as a whole. 65-year-old man has a 50% chance of reaching it to age 84. So the point is, retirement could very easily last much longer than you think. And we certainly had some thoughts on and I guess that would be along the lines of what we were just talking about. Be a boring investor, if you will, not a knucklehead one. And that's the key to long-term investment results. Similarly, Social Security, right? Social Security obviously only providing a portion of the income. It basically provides a stream of income that would equate to being in the lowest quartile of income earners. Ultimately, the solution there, you want to start small and at least do something when it comes to saving for retirement, because ultimately you're going to need something other than retirement. So, but there's a couple more things that we wanted to share with our listening audience as well. So we'll do that in this segment. Welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. My name, of course, is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where we got a team of good folks who also happen to be certified financial fiduciaries as well. And they stand ready this week to help you change your life with a successful and cost-effective financial plan. So what are some of those other surprising statistics? And this one may not be as surprising because it certainly appears in the mainstream media from time to time, but that is the simple fact that Americans are way behind on the amount of their retirement savings. How far behind? Well, here's the numbers. And the reality is what has happened over the course of the past 20, 30 years, right, is that we've gone away from sort of being a pension-based system where, okay, I'm going to spend X number of years at the company, and then they're going to generate out Y amount of a retirement benefit to pay me when I get to retirement. We've shifted away from that to being one where you've got to sort of save yourself, and the average person not doing enough to sort of save themselves. When you consider latest PricewaterhouseCoopers report shows that the median retirement savings for individuals aged 55 to 64, so that's the group that's getting sort of close to or about ready to retire, the median average retirement savings is about $120,000. That's not going to be enough to supplement your Social Security. For those ages 35 to 44, the average balance is about $37,000. That group still got some years to sort of catch up, if you will, but the average retirement savings is pretty low. The reality is that that's going to force more people to live, to work longer, right? There's no other way around it. You're going to have to kind of keep making sure that you're continuing to work. Maybe that also means that you delay Social Security all the way to the maximum of 70, because that way you maximize out that Social Security benefit. That's certainly a good idea if you're kind of in that group where I've only got that average retirement savings and I'm 55 to 64 and it's only $120,000. Then you probably don't have any other strategy other than to continue to chug along and delay taking Social Security until that maximum age, which is age 70. Similarly, a lot of folks still lack a retirement plan. Obviously, the transition out of the pension option and over into the more save it yourself in some type of 401k or IRA, the median private pension annual benefit for those that do have, because so a lot of the pension plans aren't really necessarily generating out a whole lot of money these days anyway. The median private pension annual benefit is now only about $10,600. So not a lot that's coming from those pension plans anyway. And unfortunately, the 401ks and things like that, in 2022, there were 60 million active participants in 401ks, which sounds like a lot until you realize that the workforce is 160 million people. So there's like 100 million people that aren't participating kind of in that 401k, which means only about 40% are participating. So the solution on there, obviously, make sure that you take advantage of the plan that your employer offers. Now, one of the things that we always hear on that is, well, my employer doesn't match or only matches up to a certain level, so I'm only going to do that level, or I'm not going to do it because my employer's not matching. Look, that misses the point. The match is extra. The match is a bonus, if you will. The reality is, what we're talking about is making sure that you need to be saving for your retirement. And that means that regardless of whether they match or they don't match or whatever the case may be, make sure that you are putting a reasonable amount away towards retirement. Particularly if you're behind, you need to even put a greater amount away. Think about 5, 10, even 20%, depending upon where you are certainly some good numbers to do it. That may be more than what they're matching, but at the end of the day, it's important to try and fund that. And certainly the employer plan is super easy, right? It just comes out automatically from your paycheck and ultimately winds up being a great option, certainly a great option for ease of use. So remember all of these statistics that ultimately put the burden of retirement more on you. Remember what we talked about earlier in the program. Don't be a knucklehead. Don't chase after some of these silly things that have become all the rage over the course of the past couple of years that we've seen blow up dramatically over the course of the past few months. Be a boring investor. Be diversified. Be consistent. And ultimately, that's the key to long-term investing success, because you're going to need that, because when you start to look at these statistics, Social Security ain't going to cover it. You're going to live longer than what you think, and ultimately need a plan of action for that. So certainly some things to be thinking about as we think about retirement and how best to plan for that. Well, that's about it for this week's episode of Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you change your life with a successful and cost-effective financial plan, go to our website, NelsonFinancialPlanning.com. Fill out the Contact Us form to set up an absolutely free conversation, or you can call our office directly, 407-629-6477. We still have live human beings that actually answer the phone. And remember, we don't believe in account minimums at Nelson Financial Planning, because our purpose is to help you get a financial plan with better results at a lower cost.